Bros. On today's show, we're dispelling some financial myths, and in no area are there more myths and misconceptions than when it comes to taxes. In fact, we were just talking about some of them on the break. With us now to clear up some of these are our very own tax pro, Greg Porcaro, CPA and partner with Trainer Porcaro Associates. Greg, thanks for being back with us on the show.
My pleasure.
All right, let me start with one that's certainly very widely held. This comes up all the time. Does a home office deduction really increase your audit risk? People have gotten very afraid of the home office deduction over the past several years because they think this is true.
It's so persistent. I get this question all the time. As soon as I look at a situation and evaluate the potential of a home office deduction being appropriate, the first question I usually get is that going to increase my audit risk? And it doesn't. The bottom line is it doesn't. This matter was resolved by the Supreme Court in 1993. They laid out very specific rules. They're relatively easy to follow. And beginning next year, they even streamlined the process. They came up with a safe harbor home office deduction applicable next year. So it really isn't. As long as you meet the criteria, in and of it, that's really the key, then I have no concern at all about using the home office deduction.
And is it fair to say with a lot of these myths that have to do with increasing your audit risk that the methodology that the IRS uses for determining who they're going to audit and who they're not going to audit, it's fairly proprietary. It's not like it's out there in the public sphere exactly what's going to. There's a lot of factors that go into it, I guess, is what I'm trying. And they don't always tell you what those factors are.
In fact, they
don't want you to, right?
They never tell us.
Right. So here's another one, and this is one we were just talking about. A lot of people, particularly business owners, I would imagine, as both you and I are under the impression that canceled checks, credit card statements, things along those lines are valid documentation for deductions. And obviously this would apply to individuals as well. Are those things going to suffice if push comes to shove with the IRS?
In many cases, they will not suffice because all they indicate is that you spent money on something. They do not determine whether that's something that related to that business activity or maybe for individual or rental activity. So it's very important, particularly with credit cards, to keep the receipt so you can prove that the items that were purchased were not for personal use, that they're related to the business activity.
So it's the invoice, it's the credit card printout that you signed, it's whatever the backup is that shows exactly what the expense was, not the fact that you wrote a check or put it on your credit card that's at issue there.
That's correct, and this is particularly important for charitable contributions where you have the extra criteria for certain contributions to get representation from the charitable organization that there was in fact a donation. So just a canceled check and a credit card receipt, even if it's to a school or a church, you have to get something from that school or church that says this was a donation and you received no tangible benefit in exchange for that contribution.
You got to have those receipts. Now, of all the myths we're going to talk about or have talked about, I would say that this is probably the most pervasive. People get a big refund, they think they've hit a home run, they think they've done it exactly right. Tell us why a big refund is not what you're aiming for when you're doing your tax return.
I'll distinguish one thing. For self-employed people, we'll generally build in a little bigger cushion because their income might not be as predictable. So you definitely don't want to be on the other end of that spectrum and owe a substantial amount. But in general, what I find with individuals, particularly who have wages and they have withholding, is at the end of the year, we'll do their return, there'll be a large refund. And then I'll notice they didn't put any money in their 401k or anything significant. And I say to them, most likely, had you realigned your withholding and 401k contribution, your net pay might have been very comparable, and you would have been putting money away for retirement. Yes, you would not get that big check, which ultimately is spent on stuff. I mean, some people look at it as a savings account.
Savings account, sure.
And that's not really the right way to look at it. You have to, as you know, manage your money as you're earning it. And I think the best thing to do is to try to put money in a retirement account if it's available from your employer, and manage your refund to an acceptable level. You definitely don't want to get back a substantial refund if, in fact, you could have used that money more effectively throughout the year.
What people want to focus on is their overall tax liability from year to year, not necessarily how much they over or underpaid from year to year. And I think that's something that people sort of disconnect in their heads.
Absolutely.
Now, let me ask you another one, fairly common. Are minors and the elderly required to file a tax return?
Well, the misconception is sometimes that they're not. I've had a lot of...
That there's some age cutoff.
And there isn't. If you earn money over certain limits, depending on whether you're a minor or an elderly, you have to file an income tax return. And that's just the way it is. So the common scenario is you have a child who otherwise doesn't have any income, but they may have had stock in a portfolio and they sell it. Well, their gross proceeds have to be reported even if there isn't a gain. So we see that situation come up, very frequently. And plus you have the kiddie tax problem, which in some cases creates a tax liability for a child they didn't even realize they were going to have.
Or in the elderly, oftentimes their only income is Social Security, in which case they may not necessarily have to file a return. But you also have a lot of elderly that have retirement income, IRAs, things like that, that are going to make it necessary to file a return.
That's correct. And the way
right?
those things blend, Social Security in of itself might not be taxable when you
But
blend
if you have
them,
other income, it's
you
going to
might
make
have
it taxable.
Social Security.
All right, we could probably go on with this for an entire show, but we're going to hold you there to learn more about the reality behind tax